Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, hope you survived last week. It was Whiplash Wednesday. One day the market plunging, the next day swinging up, and then we, of course, had flash crash Thursday. How did you, before we go into this week's show, find the events of last week?
Well, I didn't do much trading last week, actually, so it was fine. It was quite nice to be sitting and watching it from the sidelines. What was extremely interesting, and I reckon it's the most crazy thing I've ever seen in my career in the markets, was what the Swiss National Bank did and the movement in the Swiss franc versus the dollar and the euro. Within minutes we saw the Swiss franc moving 25% against the likes of the euro and the US dollar. And we're not talking about Swiss franc versus the Zimbabwe dollar here. We're talking about a couple of the world's biggest major currency crosses. To see a move like that is just unbelievable, and there's been a hell of a lot of fallout from it. I think we're only beginning to see the tip of the iceberg in terms of the forex providers that have been hurting from that. So that was very interesting, and so glad we were on the side when that happened. Yeah,
and just maybe one more comment before we get into the number of today's show. The leverage that was taken out in some of that forex trading. 200 times in some cases, and I spoke to the Saxo Bank guys yesterday. They said 100 times is their maximum, and I thought that's still pretty large. They thought 200 times was off the charts. I mean, we trade a maximum of, say, 10 times leverage sometimes.
Well, look, with our CFD products on stocks in South Africa, typically you can take about 10 times leverage, sometimes maybe a little bit more. But the reality is that on those big, really developed forex crosses, the movements are typically so small that the providers of those products can afford to give you, large amounts of leverage. You don't expect something like that to happen, where a developed currency cross moves 25% in a matter of minutes. It's just absolutely unheard of. And to me, that was not a black swan event. That was like a whole flock of black swans at once.
Okay. Well, let's have a look at the bigger picture as it stands at the moment. And I know you want to start off with the top 40 as we see it.
I want to just take a look at our market and just show the lay of the land as it is. We've got the chart of the top 40 up here, and we'll look at the relative strengths of each of the sectors in a moment. This chart of the top 40 I showed last week, and basically we're looking back over the last year worth of trade here on the top 40. And you can see it's got this sort of rather large, potentially topping type look to it. I don't know. We'll see which way it resolves itself. I mean, certainly over the last 3 or 4 months, you can see it's gone into a very, very volatile patch. And at the moment, the key levels really that we've got to watch on our top 40 are 41,500 at the lower levels and 44,000 at the upper level where there's resistance. And we need to see which way the market breaks beyond either that support or that resistance to then determine. At the moment, as things stand, we're pretty much right bang in the middle of that range at the moment. So difficult market to trade, and difficult to say with any high degree of certainty which way we're going to go, higher or lower from here.
But your overall theory was that we would head lower and then we might have a break higher.
Well, that's my feeling. When you get a pattern like this, which has got successively lower highs and then all these flat bottoms down here, very often the higher probability likelihood is that you're going to see a break to the downside to resolve that. And I still think that is a fairly strong possibility. But it's difficult to say. And of course, this week we've also got stimulus likely to be announced from the ECB, the European Central Bank. And what's that going to do for markets? If they inject 500 billion euros of liquidity into financial markets, well, what is that going to do for the picture?
Potentially nothing.
Potentially nothing.
It is priced in.
Absolutely. It's widely expected. It's not like it's going to become as a shock event. So it'll be interesting to see the market's reaction to that. Nonetheless, we can speculate till we're blue in the face. I think the reality as we see it there is that our market is currently stuck in that range. It's right bang in the middle of the range as things stand right now, and you can really flip a coin as to which way it's going to go from here, I think.
Yeah. Well, relatively speaking, how do the indices stack up against each other?
Yeah, let's have a quick look. So this is we're looking at the 3 major sectors of our market here, so industrials, financials, and resources. The first chart is the industrial index relative to the all-share index. So just to explain how this chart is derived, what it really is it's a representation of the historical values of the industrial index divided by the corresponding historical values of the all-share index, and those values are then plotted on a graph. So when you see a situation like this, where you've got a very strong rising trend, all that really is telling you is that the industrial sector of the market is outperforming the all-share index. And that trend has been in place really since 2009, actually, with the odd gyrations here and there. But for the most part, industrials remain where all the action is in our market. And you can see that trend is still very strong, and for now, there's certainly no reason to want to bet against that trend of outperformance for industrials.
Even though there's been that little sort of break at the top there.
Oh, it hasn't broken the trend, though. You know, if you look in the past, there's always pullbacks. There's the trend rises and then there are pullbacks, and we're currently seeing a pullback in the relative chart, but the trend hasn't broken. So right now, the trend is your friend, and we've got to respect the fact that industrials remain strong.
What about financials? Because financials has also been okay, possibly not as strong as industrials, but still okay.
Yeah, not as strong as industrials, but also been a very strong sector of our market since 2009 as well. And again, you can see quite a clear rising trend over there. What's happened over the last 2 months or so is that the financial sector, on a relative basis, has been consolidating. And you could argue that this is almost like a little flag type of pattern within that rising trend. And these flags do typically break in the direction of the trend. So that would argue then for the possibility of an upside break. In other words, the potential for financials to once again start outperforming the all-share index. But you know, whichever way you look at that, that's a fairly encouraging chart, and I think you'd still back the fact that financials are in an outperforming trend relative to the all-share index.
Okay, so let's look at the non-encouraging chart, which is once again the resources index, and it's been like this. What? I mean, how many years has it been like this now?
Well, it's really also been like this, probably even longer than 4 years, really. In fact, this whole bull market since 2009, the resources sector of the JSE has underperformed the rest of the market horribly. And if you look at some of the shares that make up the resource sector, you can see why. I mean, a lot of them, BHP Billiton, Anglos, African Rainbow Minerals, Kumba and the like. I mean, these things are sitting at multi-year lows now. So it's understandable why the resource sector as a whole is underperforming the all-share index. And at this stage, you've got that downward trend, that consistent pattern of lower highs and lower lows. There's nothing right now to tell me that that's going to change anytime soon. You could argue that there's value, perceived value in the resources sector, and I think there's a case to be made for that. But you know what? These things can be a value trap. And what this graph is telling us is that for the time being, the underperformance trend for resources remains intact, and therefore you probably want to stay away from resources on a relative basis. Your higher probability trades, if you're looking to trade the market from a long perspective, are likely to be found in the industrial and the financial sectors of our market.
Okay, which leads us to the share that you're going to be looking at this week.
Correct. So that we're looking at Sanlam this week, and I've done a trade in the stock yesterday actually for our portfolio. So what you can see here is that the Sanlam has gradually been trending higher. What interests me is that the stock has been testing the 200-day moving average here. And in the past, any pullback to that 200-day moving average or just below the 200-day moving average has actually been quite a nice buying opportunity. And we certainly have noticed evidence of buying in the share over the last couple of days or so. We saw quite a big reversal in it last week, Thursday, and we've seen some buying at the lower levels over the last couple of days. You can see there's also this sort of channel type of pattern here. You could maybe argue that's a bit of a flag type thing. And again, within that, we've then got a smaller falling wedge pattern. I've gone along, based on the reversals that we've seen there, based on the fact that the stochastic is extremely oversold and it's begun to turn up, based on the fact that we seem to be finding support at this area. I went in and I bought some Sanlam for our portfolio at 63 Rand 45. My stop loss, 62 Rand 50, which is, and I'll look at that as a closing basis. It hasn't closed lower than that level in the recent days. And I'm going to look for a move up to 68 Rand here. So if I plot my little risk and reward blocks on that thing, you can see the red block represents the risk. In other words, that's the difference between where we go into the trade and where our stop loss would throw us out. And then the green block is the potential reward from where we buy to where we would hope to sell up at 68 Rand.
So you don't think it might, just the one point on Sanlam, and I think we've entered into, we've traded Sanlam before, not always particularly well, and sometimes it's just done nothing for us. Would you give this one a little bit more patience? Because, I mean, if you look at the chart over the past year, it's sort of taken a while to kind of grind slowly higher, but it did get there.
It did get there, yes. Yeah, look, you're right. It has these periods where it can go sideways and be quite lethargic for a number of months. I think at the moment it's fairly oversold, so the potential for a bit of a snapback is quite high. We're not looking for a massive move here. We're really just looking for a move back up to the top of that channel. So we're talking from, 63 Rand up to 68 Rand. That's, 5 Rand, about 7 or 8% movement in the share price. It can probably do that. And look, we will hold on and be patient, but at the same time, we also don't hold on to these trades indefinitely. Because remember, they do tie up focus and they do tie up capital and whatnot. So if it really does become tedious, well, then we'll execute a time stop loss at some stage. But certainly, I'll be willing to give it a couple of weeks.
There's nothing worse than boring oneself with one's own trading. Gaso, looking at that trade in greater detail.
All right, so we've gone in, we've bought at 63 Rand 45. My stop loss is 62 Rand 50. The risk per share, therefore, is 95 cents. I'm risking 1.5% of our trading capital here. So that we've got 263,000 Rand of capital at our disposal. So 1.5% of that works out at 3,945 Rand. So if I take that capital risk and I divide it by our risk per share, that gives me 4,152 shares. So if I round that down, 4,150 CFDs, and that's what I've bought for our portfolio this week. My target, 68 Rand, and the risk to reward ratio on this trade, therefore, is 1 to 4.8. So it's a good risk to reward ratio if it works out. If we get that 68 Rand target price, then we've got a really nice risk to reward ratio set up here.
Garth, and trading 1.5% of the capital, is that just because you're a little bit cautious of markets and if there were some sort of downturn, and it's been really hard to call in the last week or so, you wouldn't want to get carried out?
Well, that's right. And I think also the 1.5% does just give us a little bit of flexibility in terms of any slippage around a stop loss and that sort of thing. Because you know that I always use manual stop losses. And that does sometimes result in a little bit of slippage. So just reducing the portfolio risk slightly does actually give you just that little bit more leeway in terms of the slippage if there is any slippage.
Just before we end off with, because we have got a couple of minutes, are you quite glad that you've actually stood on the sidelines? Because, I mean, would you have been able to call the swings that we saw in the markets, even with hindsight? Do you feel that some traders have got their fingers burned quite nastily over the last week or so?
It's very possible. When the market shows extreme volatility like we've seen, then obviously people do burn their fingers. But then at the same time, you must remember that it's a zero-sum game. So as much as there will be some traders hurting, there's some others that are probably jumping for joy because they've managed to capture that volatility correctly. I've largely been sitting on the sidelines, and I guess it has been somewhat comforting because we've seen the market moving. The top 40 has been moving more than 1,000 points in a day on quite a few occasions recently. So you get yourself on the wrong side of that, and it can certainly hurt. Of course, you can also do really well if you get on the right side of it. I think it's been a nice market if you're an intraday trader and you've been able to capture that volatility on an intraday basis. But the style of trading that we do on this show, where we look to hold positions for a couple of days to a couple of weeks at a time, it can be a little bit hairy, that extreme volatility. So yeah, I suppose I'm comfortable to have been relatively sidelined, as it were, over the last week.
So Garth, what does the portfolio look like then?
Right, so we've done 2 trades this year. Look, the one actually we did last year and we carried it over into this year, but that was a trade on the Rand dollar currency future where we made 13,000 Rand and we blocked that profit in some time back. Then we've got the Sanlam trade that we've discussed this week where we long 4,150 CFDs from 63 Rand 45. That seems to be working for us at the moment. So the portfolio value sitting just north of 263,000 Rand. That's up just over 5% for the year to date, which is a nice place to be. We've got some money in the bank. It does give us a little bit of confidence and a little bit of a buffer for any new trades that we enter into.
And upcoming courses, because it looks like it's quite busy for you in the next few months.
Yes, it will be. Certainly starting towards the end of February, it's very busy. I'm running Understanding CFDs courses and high probability trading courses in each of the major centres, so Johannesburg, Cape Town and Durban. You can see the dates there for all of those courses. If anybody's interested in attending these courses, please email me, garth@traderscorner.co.za, and then I will send you the details for those courses.
And Garth, just to end off with, next week you're not going to be here. You're going to be swooshing down the ski slopes, counting your pennies for your après ski, no doubt. But we're going to do a show on stop losses. Just a quick word on that.
Yes, and I'm not going to be in Davos, by the way. I'm going to be somewhere else in Austria skiing. But yes, I'm not here next week. At the end of last year, the final show of December, we did an expose on all of the trades that went wrong for us last year. And you can always learn a lot out of the mistakes that you make. And the key lesson out of that show was to illustrate how important stop losses were. And really, that the main secret to success of Traders Corner is that we keep the losses small when we are wrong. So we're going to replay that show next week. And for viewers who were on holiday in December and didn't get to see it, I think it's extremely interesting. The message is very strong. So watch that show next week while I'm away and take the message out of it. Stop losses are vital.
Yeah, and we'll think of you doing well on the black and diamond runs. That was Traders Corner for this evening. Thanks as always to Garth McKenzie, founder and editor of the show.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.